Hello and welcome to The Enterprising Investor, the flagship investment podcast for CFA Institute. I'm Mike Wallberg, and I want to do a little thought experiment with you today. Imagine you have a car to sell. Blue Book tells you it's worth $50,000. Recent sales say it's worth about $50K. The dealership, well, they say it's worth 45, but that's another business model, as we know. So call it 50 grand. But you know a secret. There is a diamond necklace in the glove compartment. You tell the buyers hoping for a higher price, but there's no diamond necklace row in their models, so they just shrug. What do? You pull the necklace out and you sell it separately, of course. So Andy Lee is here today to talk about how he's collecting those diamond necklaces that no one seems to care about besides him, some alert private equity managers, and his clients. Andy entered college at 15, earning bachelor's and master's degrees in accounting before spending 5 years in investment banking and private equity, and then founding Parallaxes Capital in 2017, where he's now CIO. You may have seen or heard him in the Wall Street Journal, Forbes, NBC, or on the Capital Allocators podcast, and today he's with us. Welcome to the show, Andy.
Thank you for having me.
Okay, enough with the suspense. Andy, please tell us, what are these diamonds that you collect?
Absolutely. So we monetize tax receivable agreements. For the investors on the podcast, think about them as what pharmaceutical royalties were in the 2000s and what musical royalties were in the 2010s. So long dated, annuity-like cash flow streams. These are created by private equity firms as part of public offerings as a result of, to your point at the start of the discussion, a misunderstanding of value as a result of it not being a value attribute that most are keenly aware of. When companies go public, private equity firms have been extracting it for themselves for the better part of the last 30 years, delivering incremental values to their long-term investors. That is the limited partners in their funds. For many of them, we are secondary market liquidity providers for these assets, delivering them dollars today in return for hopefully more dollars over time.
So walk us through kind of how that works. You've got a private company, the PE firm owns it. It goes public. A few years later, you enter the fray. Like, just walk us through at a high level, kind of how these things come to become, in the secondary market with you guys.
Absolutely. So here in the United States, in order for a company to go public outside of two separate other formats, that being a MLP or a REIT, they need to be C Corps. Many companies, especially those that are particularly capital efficient, think of them as cash flowing businesses from the get-go that are asset light in nature. Many of these businesses are able to remain in what we describe today as a flow-through format for tax purposes, while they remain private assets. When it's time for them to go public and become a C Corp, they undertake what we describe as a tax transformation from a pass-through partnership, LLC, to a C corporation, at which point of time a large tax asset is created known as a step-up. That step-up delivers to the newly public company a valuable tax asset that would help reduce the amount of cash tax savings they would be able to derive in time. And that should accrete to the overall value of the business.
Okay, so this tax asset is created at that point, and then effectively the PE managers, they have as I understand it, they have, say, a 10-year fund. They go public in year 8, and these assets are sitting there. And so, at what point do they sell these on to you guys? Like, how does that work?
Absolutely. And so think about a typical portfolio company going public in year 6 to year 8 of a typical fund. Upon going public, they may sell down over the next 2 to 4 years their equity value, the remainder of their equity value, at which point of time they are in year 10 to year 12 of their life cycle, For us, that's typically when we step in as part of an end of fund life consideration. Many of them are looking to fully realize their assets and wind down their funds. So we step into the breach, providing that upfront liquidity for it, delivering them significant value upfront for those assets versus holding on for another 12 to 14 years.
So how big is this market anyways?
Absolutely. So when I started the firm in 2017, it was about an $8 billion market. Today, on the back of the rise of adoption from private equity and other constituents, that number is closing in on $30 billion. So it's grown significantly over time.
Hmm. So are there any companies we know that are using that?
Absolutely. So names that we have in our portfolio that are consumer oriented might include the likes of a Remax, a Shake Shack, a Duff and Phelps. And so this is what, as you think about the proliferation of TRAs, one out of every 10 names in the US public markets today that have gone public via IPOs have adopted the TRA. And as we believe that the number of IPOs that were sponsor backed will increase share with time, that likely see a further increase in the number of TRAs for every company going public.
Can you talk a bit about that pipeline? Because if it's sort of following the flow of IPOs, we look back over the last few years. We've had kind of a surge and collapse of the SPAC market as one source of these, I imagine, and then the traditional IPO market. What are you seeing there, and kind of what's your outlook for the flow of these things, aside from more companies adopting them?
Yeah, so what I might suggest is many of the names that went public via specs likely were candidates for TRAs. Um, or at least fundamentally the liquidity of providing liquidity to them, primarily because credit quality for many of those names run the gamut um, from speculative to cash flow positive businesses. One, two, you obviously have seen in 2022 and 2023 a drying up of the IPO market. However, in 2024, you've probably seen multiple market pundits suggesting that the IPO markets are on the rise and the recovery is well underway. With that, you have seen sponsors who have in time grown their businesses, portfolio companies significantly. That increase has resulted in fewer and fewer sponsor to sponsor trades, primarily because some of these businesses are now so large that the only conduit for them to exit is either a strategic sale or a public offering. As many of you might well know, as your listeners know, there has been significant scrutiny around M&A transactions here in the US as a result of the Biden administration's push to increase competition and increase the range of choices for consumers. You've seen the blocking of some might deem to be rather innocent M&A transactions, such as an iRobot to Amazon, among others. And so, as a result, that has put a freezing to the exit markets on a private M&A side of the equation, resulting in the only viable path for many of these large sponsor-backed portfolio companies to exit via the public markets. And so we believe that the pipeline is full of such opportunities likely to come to market in the relatively near future.
So I joked off the top about it being, the diamonds, and really what I was talking about there is efficiency or inefficiency, right? Like, so why is it you think that this inefficiency, exists in the first place, and in many ways has persisted for a long time? Like, why does this market exist whereas it didn't before?
I think there are several reasons that I might posit as to why the opportunity exists for a player like myself, first and foremost, is around domain expertise. Much of the information requisite to understand the tax asset is publicly disclosed in a company's 10K. And there has been a push from analysts for even more disclosure, specifically from cash flow sensitive analysts such as the rating agencies, who are very acutely aware of the value that tax assets bring. However, in order to assess the value of a tax asset, not only do you need to have the information, one, you need to have the expertise in order to interpret what the information is suggesting, whether the company is going to have a cash tax savings or a cash tax liability that they will be due. That element is something that is fundamentally lacking in the analyst training that we have from traditional investment management training programs. One, two, I would attribute that to be a incentives discussion. We have, as a investment management, been pushed towards either active or passive investing. Within the passive investing algorithms that many of us have started orienting our investment portfolio towards, they are very focused on one, multiples that are very centric towards one, growth, or two, sales multiples or EBITDA multiples, none of which capture the value of tax assets. For active investors, think of them as the Citadel Millenniums of the world. They are looking to understand assets from a quarterly basis. Does it have an impact upon EPS? Even if there is significant dispersion on the outcomes as it pertains to free cash flow, there is little to no value they deem to be available to them. And it doesn't have much, if any, impact upon the stock price. And so, from an incentives perspective, the passives don't care. The active managers at Millenniums of the world don't care. And so, it really then is stuck to the active managers that are focused on intrinsic value, those being the single manager hedge funds. And while they care, it doesn't move the stock price. And so it has become a piece of expertise that, while valuable, has become more and more ignored over time.
So how do you value them then when you're doing these deals?
Absolutely.
It's cash flow, right?
Yeah, it's all about free cash flow when it's all said and done. Unlike other assets where you are somewhat relying on a greater fool theory, we are very much fundamentally focused on what cash flows are we valuing, when are they going to become available to us, to ultimately inform our notion of the total size of the asset, as well as what we are then willing to pay based upon the riskiness of those assets, as well as certainty that will be delivered to us for those assets. And so I think it's a little bit of a exercise where we are fundamentally understanding the cash flows of a business, which then inform when we would realize those tax assets and what we would then subsequent to that pay for those tax assets.
So I guess if you go back to the investment banking speak that we both did at the beginning of our careers, it would be like a blowdown that you do on, on like an oil company, which is what I used to do, E&P deals, but effectively like a blowdown, right?
Yeah, the only difference that I would make is there's not much in the way of a P&A expense at the very end to close down the mine, among others, and rehabilitate the land.
It's just a stream of cash flows that reduces over time, and you have some confidence of when that will be, and the level and frequency of the cash flows.
That's right.
So on that, I guess just digging into the I don't know if the word is enforceability, but I mean if we're talking about an agreement to receive the value of these tax shields over time, like how do you make sure that they're paying out what they're supposed to? Like what's the audit trail there?
Yeah. So there is a fundamental contractual obligation on the part of the company, first and foremost. They enter into a contract through which there are potential cross default obligations relative to their debt. that is available to us. So obviously, no company is going to want to potentially risk tripping their debt covenants, among others. Two, oftentimes the beneficiaries of the TRA are given to not only the sponsor, many of which we're transacting with, but also co-investors and management team members. Those are other constituents that we're very focused on. And so many of them are still in management and are aligned with us in getting our cash flows. And I think the last aspect that I will orient you towards is that no company in the public market wants to see their stock price drop as a result of some might deem to be aggressive tax positions. And you've seen that in the case of the likes of Caterpillar, where their stock price dropped almost 20% overnight, call it 5 years or so ago, as a result of aggressive tax practices. And so, as we think about our incentives, we are very much aligned with some describe as the only stakeholder that wants to make sure that a company pays its fair share of taxes, primarily because on both the equity and the debt side, as a result of them being able to trade in and out relatively in a liquid format, they both have incentives for the company to have the most maximum aggressive tax position that reduces its tax liability. And so that's something that we're very focused on, especially from some deem us as a ESG investment as a result of that.
Yeah, that's right. You're the kind of the S in ESG, where you're sort of trying to be the police to enforce or make sure that they're paying their fair share of taxes.
Absolutely.
So just stepping back a sec, Andy, here, and just thinking about tax as an investment product or asset class. One thing you said to me in the green room is that tax is the largest asset class in the world that no one's ever heard of. I wonder if you could talk a bit about what other businesses are intermediaries in tax payments that were there before you came along.
Absolutely. So if you think about here in the US, we just cleared tax day on April 15th. Unfortunately, many who don't live in Massachusetts, for which you get 2 extra days. But on May 15th, H&R Block, which is the leading tax filing provider, they would tell tax filers, hey, Michael, the IRS is going to pay you $100 in 2 months. Why don't we just give you $90 today for it? Effectively offering consumers a factoring solution. And that's when they literally make hay. And it's a huge part of their business today. Similarly, on the other side of the globe, you have Global Blue. If you think about many of our wives and significant others doing holiday shopping and luxury good shopping, they would be eligible for what they call a VET tax refund, a value added tax. And when you go to the borders, as you're about to fly home back to Canada, they might say, Michael, your Global Blue, instead of filing online for your tax refund for €100, we'll just give you €90 today, and you're done. Take your money and go home. And you're like, wonderful. Let me just do that. It's a huge business today, owned by private equity, and there are so many flavors of opportunity. Tax is the largest asset class in the world that no one's really thought about. And the biggest challenge to the space becoming more widespread is the lack of commercial capabilities, driven by the fact that tax professionals, myself included, rarely, if ever, speak English. And unfortunately, most of the commercial world not real hearing the word tax and just wanting to run away. I mean, there was actually a statistic that is being memed all over the web right now that a quarter of the Gen Z population here in the US are suggesting that they need therapy in order to get past tax day.
Wow, a quarter of them want therapy to deal with their tax situation. That's crazy. And that's interesting actually as well, Andy. I didn't realize. I mean, I've kind of walked past those booths in the airports in Europe and never really clued into the fact that that was actually a private business that was doing that. You kind of think of it as just part of the government mechanism, but they're taking a turn on every one of those transactions. That's interesting. So you talked a bit about about how they're valued. How do these things perform? Like, how do you mark them?
Absolutely. On a quarter to quarter basis, we undertake management marks. However, on an annual basis, we are partnered with a big four to help us assess the value of our assets. So, look, I don't think it's lost as a fund manager. We have a fiduciary duty and we have to undertake valuation exercises that pass the sniff test. And so, for us, we utilize consensus projections to understand the viability of a business on a go forward basis. Those change quarter to quarter, which then ultimately inform our views as to the cash flows that a business will produce, and corresponding to that, the cash tax savings or liabilities utilized or saved. Those then inform the fundamental cash flows. We apply a uniform discount rate in line with that of our auditors, which then ultimately involves a fair value that is within that we then utilize for our financial statements on a quarter to quarter basis. That mark will move based upon the value of the asset changing from consensus projections, among others.
And do you just flow through the cash flows then as distributions or dividends?
That's right. So that's what we deliver cash flows to our LP base on a annual basis.
And what do those yields usually look like?
We seek to deliver our investors anywhere between a 15 to a 20% yield on their investment in any given year.
I'm just going to give some dead air for a moment there for listeners to take that in. 15 to 20% on these flows. That's pretty crazy. And it's a lockup of what, like 10 years usually, or how does it work?
Randomly, our fund one is actually a 21-year fund. I started fundraising for that vehicle when I was 26. And being Asian American, I look relatively young. I can thank my mom for her good skin, but there were people who joked and asked if I was even 21 when we told them we were raising a 21-year fund.
And is it an open fund? Can is there any liquidity out, or are you in for that duration?
So we have raised six funds in the last 7 years since we got started. They are all closed-ended vehicles. However, because we distribute all cash flows received back to our investors, many of them view it as long dated from when you will get your last dollar of cash flows, but they are getting a whole ton of interim cash flows over time versus waiting for that a single lump sum at the very end. So the weighted average life of our vehicles are closer to 5 years than anything else.
We had Daniel Paris on the show a couple months ago, and he wrote a book about the return of dividends to investing in the U.S. So he'll I hope he listens to this one. He'll love it.
Absolutely. We need more eyes and ears because, look, like I said, tax is the most misunderstood space out there. We just need more capable hands from who can bring commercial capacity to bear on the space.
So we're coming to the end of our chat today, Andy. I just want you to think back to when you first started. I think it was Citi you were at. So when you were first day in the chair in investment banking, if you could take yourself for coffee on that first day, what key piece of advice would you offer yourself?
I didn't fully appreciate this. I started in M&A, and I always thought from a junior perspective that is the most prestigious seat. I didn't fully appreciate that while from a junior's perspective, it is the most prestigious group in the bank, it is from a senior's perspective the most or least valuable part of the seat. Why do I say that? And you likely remember from your time in banking, the one who owns the relationship with the customer, i.e., a Barrick Gold, a Anglo American, among others, those are those coverage bankers were the rainmakers versus the M&A MD or partner was just a cog in the wheel, an execution partner of sorts. And they never, because they didn't own the relationship, they were mere processors of what some might describe as cost centers. What is that to say for your stakeholders? Sales is ultimately the most senior skill set that we all need to build in life. You had to sell your significant other, my wife, to marry me, yourself, and me. You have to sell your kids on eating vegetables. You've got to sell people to give you money to invest, that you're going to be a good steward of their capital. You're going to have to sell people that they should believe in you and the product that you're selling, and that you have their best interests at heart. You have to sell employees that you're going to be a good steward of their careers. Ultimately, the top job in any organization is a sales job. And that's something I did not appreciate that early on in my career.
And particularly good advice later in your career now as AI starts to eat up more and more of the sort of iterative processes.
Absolutely. It's here to eat our lunch. Papa Lee is actually an AI professor. I don't profess to know anything about technology. I barely know how to turn on a computer.
I've been speaking today with Andy Lee, founder and CIO of Parallaxes Capital. Thanks for shining a light on a rare, inefficient corner of the market for us today.
Thank you for your time, sir.
I'm Mike Wallberg, and this is me, the Enterprising Investor.